Good morning, this is DealBook for Saturday, August 15, 2026. I'm Andrew Ross Sorkin, and welcome to your daily briefing. We've got a packed edition today, a deep look at the escalating battle in wearable health technology, a conversation with investing legend David Booth about staying calm in a world that increasingly resembles a casino, and a roundup of the week's most consequential business and market news, from inflation and prediction markets to AI, sports franchise deals, and a quiz on the shifting geometry of global oil flows. Let's begin. Do you wear an Oura ring or a Whoop band to track your exercise and sleep? I do. And if you do, you're part of a phenomenon that has drawn every major technology company into a fierce competition, not just for your wrist or finger, but for a place inside the medical ecosystem itself. Google bought Fitbit for $2.1 billion in 2021. The Apple Watch is a behemoth, selling around 8 million units a quarter more in 3 months than Oura has sold in its entire history. Oura has filed confidentially for an IPO. Whoop is expected to follow. But behind the consumer-facing marketing lies a vast, high-stakes struggle over patents, data, regulatory pathways, and the ultimate prize, becoming the device that every hospital and doctor recommends. Our contributor Brent Crane takes us into this world, and he starts with a vision of the near future. The year is 2035. You, like most people you know, have a small, button-sized device implanted in your forearm. For a recurring fee, it continuously monitors your blood pressure, core temperature, cardiovascular activity, and every other health measure a physician would value. Anything suspicious is promptly flagged to your doctor by a personalized AI system. Disease and illness are caught and treated as early as possible. This is the health-maxing future that the $44 billion global wearable industry is rapidly manifesting. Since the pioneering Fitbit tracker launched in 2009, consumer interest has powered the category. But what has caught the attention of venture capital firms and the world's biggest companies is a vision that could be even more profitable. As Jitesh Ubrani, an industry analyst with IDC, puts it, the end goal is to be part of the medical ecosystem. It's a very lucrative market to be in if every hospital and doctor recommends one of these devices. That long game partly explains why the knives are out. Oura, the Finnish-American smart ring maker, has sued 7 competitors over patent infringement. It has won against 3, with 4 cases pending. Apple Watch is also embroiled in at least 2 patent infringement lawsuits. Amid this ferocious competition, companies are taking small but deliberate steps toward integrating with hospitals and healthcare providers. Apple has partnered with Epic Systems, the healthcare data giant. Oura paired up with Dexcom, a maker of continuous glucose monitors, which invested $75 million into Oura in 2024. Oura's CEO, Tom Hale, prefers not to call his product a fitness wearable but rather a health intelligence platform. In May, Google introduced Google Health, an app that combines Fitbit data with third-party app data and your health records, meant, as Fitbit's head of product Andy Abramson says, to be the one platform to manage all of your health data. And last year, Samsung, which makes both a smart ring and a smartwatch, acquired Zelf, a platform that connects consumer health data to hospital systems. The acquisition, Samsung said, would help transform it into a connected care platform. As wearables become enmeshed in the healthcare system, parsing all that data will require sophisticated AI assistance, experts say, and there are weighty data privacy concerns to navigate. But the upsides are compelling. Beyond flagging illness far earlier than currently possible, a wearable-enhanced healthcare system could supercharge telehealth. Diagnostic tests that once required a trip to the hospital would become unnecessary. The requisite data, very much of it, will have already been beamed to a doctor via a wearable. You could see any patient at any time, anywhere in the world, says Dr. Andrew Jajam, Director of Sports Medicine Research at Mayo Clinic Health System, who studies the accuracy of wearables. Beyond health, wearables are increasingly adding features that turn the device into a key. Apple Watch lets you unlock your Mac automatically when nearby. Future devices might use your gait, heart rate, or other biometrics to log you into systems, grant building access, or authorize online purchases. But healthcare is where the real money lies. The technology is reliable enough for use in some medical contexts already. Whatever shape they come in, wearables depend on a small array of sensors, optical detectors, accelerometers, thermistors that track blood flow, movement, and skin temperature. Onboard algorithms then infer physiological signals like heart rate, sleep stages, and blood oxygen from the noisy raw data. Over the years, they've steadily improved in accuracy, Dr. Jajam says, especially in tracking sleep time spent in deep sleep or REM versus light sleep. A decade ago, he would have totally discarded that data. Not anymore. As brands work toward healthcare integration, they're building customer bases in varying ways. Whoop, a subscription wristband costing as much as $359 per year, attracts a wealthier, fitness-focused consumer. Their bands often worn alongside expensive watches or luxury handbags, Ubrani notes. But the brand has also earned the loyalty of many athletes who value its recovery and strain scores, which translate heart rate variability and sleep data into a daily readiness number. Apple Watch and Fitbit, providing less hyper-detailed metrics, appeal to a more general wellness crowd, Dr. Jajam says. Garmin smartwatches, with advanced GPS and even altitude readings, appeal to extreme athletes. The company recently released a screenless smart band. Aura, whose newest iteration is as thin as a normal ring, has leaned into its popularity with women by trumpeting features that predict menstrual cycles and ovulation windows. Wearables are becoming more proactive, too. Rather than just tracking data, they now offer recommendations: when to work out and how, when to sleep and how much to eat. This is where established brands like Apple and Google, which can pull information from other products in their universe, may have a leg up, says Ben Arnold, an industry analyst with Circana. Gemini, for instance, knows me in other venues, so those recommendations are even more drilled into me as a user. That's a big differentiation factor. Arnold adds that your AI coach could comb through your email inbox looking for correspondence from a gym, or DoorDash, or Instacart receipts, which could then inform coaching recommendations. Full-on healthcare integration, though, is still in utero. The medical industry moves very, very slowly and is very bureaucratic, Ubrani says. There are real hurdles to get over. Last year, Whoop ran into one such hurdle. After it launched a feature estimating users' daily blood pressure, the Food and Drug Administration declared Whoop an unapproved medical device. Whoop publicly refused to pull the feature, arguing that the smart band did not constitute a medical device. It's designed to help you understand how your body responds to daily life, not to diagnose or treat any condition, the company said. In June, the FDA officially backed down after issuing new guidance exempting wellness blood pressure measurements from medical device regulation, a win not just for Whoop but for the wearable industry writ large. In a LinkedIn post, Whoop CEO Will Ahmed celebrated with a nod toward the future. "We have tremendous respect for the agency's role in ensuring that medical devices are safe and effective. We look forward to continuing to work with the FDA as Whoop brings more regulated medical technologies to market." That's the landscape. A $44 billion industry racing toward a medical future, armed with sensors, algorithms, AI, and armies of patent lawyers, all while regulators, hospitals, and consumers figure out what it means to have a doctor on your wrist or, one day, in your forearm. Now, from the frontier of quantified self to the discipline of long-term capital. Sarah Kessler sat down with David Booth, the chairman of Dimensional Fund Advisors, a firm he founded in 1981 that now manages more than $1 trillion. Booth, 79, helped create one of the world's first index funds in 1971. He says he's never bought an individual stock. A pioneer of evidence-based in index investing, he rejects stock picking, market timing, and most predictions. Individual stocks, they go to zero. The stock market's not going to zero, that's a forecast I'll make, he told DealBook. His new book, Stay Calm, is about long-term, systematic investing in a world that increasingly looks like a casino. Sarah asked, "You wrote that it's never been easier for people to gamble under the pretense of investing. Tell me more about that." Booth replied, "You look at all the prediction markets and so forth, it's pretty easy to call that investing. But it really couldn't be more like gambling. And you have all these derivative contracts, futures contracts, so forth. It's easy to get all kinds of leverage very easily now. You have any number of ways of taking sometimes extraordinary risks, without even thinking about it. How has that affected markets or companies? I don't know if long-term it has much impact other than having a lot of younger people lose all their money over time. Do you think passive investing has contributed to a concentration in indexes? I think the concentration comes from people analyzing companies and saying that these companies are worth a ton of money. There's an argument that the more successful the companies are, the more they're automatically bought through passive investing strategies and overvalued because of that. Those are interesting arguments, but the index funds don't really trade much. I think it's probably the investment community really driving up prices. One of the remarkable things, over the last 30, 40, 50 years, is the movement toward index funds. Let's say it's half of the total stock market. All things being equal, Wouldn't you expect trading volume in the stock market to be about half of what it was before? Because half of it's in these index funds that don't really trade much. And in fact, we've seen a rapid increase in trading volume. I think one of the contributing factors is people may have moved away from picking stocks to timing markets and sectors. An index fund is the ideal timing vehicle. You can get in and out of the market with just one ticker symbol. Like all technologies, indexing can be used for good or bad. I wouldn't say trying to time the markets is evil, but based on all the evidence, it looks like it's more like gambling than it is a productive way to invest. In your book, you make many comparisons between investing and life. Have you always seen things that way? I had a breakthrough about 10 years ago. Really, the economy is incredibly complex and you can't model it exactly. But so is life. The stuff you can't control is important and you want to manage that. But you primarily are going to make decisions about controlling what you can control, like how much risk you take. Don't try to predict the unpredictable. Plan for it. Adapt and be flexible. And when you get off track, figure out what it takes to get back on track. That's the way you go through life. A philosophy of humility, discipline, and focus on what you can control, whether you're allocating capital or navigating a career. Booth's Stay Calm is out now. And now, in case you missed it, here's what else moved markets and headlines this week. Stocks remain near record highs after a tame inflation report. The Consumer Price Index rose 0.1% in July from a month earlier, and 3.4% from the previous year on a seasonally adjusted basis. The modest easing of price pressures gives the Federal Reserve some breathing room as it considers raising interest rates at its policy meeting next month. As Lydia DePillis reports, inflation continued to ease last month from its war-driven surge earlier in the year, but prices still remain at a high level as constrained fuel supplies have increased the cost of living. Energy prices fell last month after their spring surge, but other factors pushed up costs. Colby Smith notes that the latest CPI report helped reinforce the patient approach adopted by many Fed officials about raising rates, but it has not resolved the debate altogether. The prospect of higher borrowing costs remains firmly on the table as officials begin to lose patience about how long inflation has overshot the central bank's target. Prediction markets come under more pressure. New York City opened investigations into the marketing practices of Kalshare and Polymarket and two other operators. Prediction markets are also in legal battles with several states, including New York. On Wednesday, a judge in Seattle barred Kalshare from most operations in Washington state after the state's attorney general argued the platform was illegally operating a sports betting business. As Hurabi Nico and Santal Nurkar report, the New York attorney general on Friday sued Kalshare, accusing the company of operating illegally and in defiance of laws aimed at curbing unregulated gambling. The suit says the New York-based company has tried to avoid the state's strict regulations on gambling by allowing users to place wagers that amount to betting under the guise of event contracts on a prediction market. By ignoring our laws, Kalshare is running an illegal operation and harming New Yorkers in the process, said Letitia James, the New York Attorney General. At least 15 states have introduced legislation this year to regulate the markets. In Washington, Lauren McCarthy reports, a judge in King County Superior Court ruled in a preliminary injunction that Kalshare was breaking state laws that have tightly regulated gambling since 1889, ordering the company to stop allowing Washington residents to place bets on sports, elections, politics, entertainment, and more. Meta released an open version of its most powerful AI model. The model, Muse Glimmer, can run locally on a laptop, and Meta has positioned it as a cheaper alternative to rival AI models from Anthropic and OpenAI. As Eli Tan and Mike Isaac report from San Francisco, last month Mark Zuckerberg boldly came out in support of open-source artificial intelligence models that are publicly available to download and modify without payment or approval. The way forward, he said, was through openness and putting the power of tech into more people's hands, not fewer. On Monday, he doubled down. Meta released an open-source version of its most powerful AI model, Muse Spark. Called Muse Glimmer, it is nearly identical to Muse Spark and can generate code, reason, and process images. The release is likely to intensify a debate over whether AI should be restricted or not. Meta is also creating a $1 billion fund to support police and firefighters in towns where it has data centers, an effort to counter local pushback. More big deals. Josh Kushner, the venture capitalist, and Bob Iger, the former CEO of Disney, said that they plan to buy the Los Angeles Lakers for $12.5 billion. As The Athletic reports, the Lakers set an NBA record with a $10 billion valuation last year. This sale would reportedly value the team at $12.5 billion. Only 14 months after agreeing to purchase the Lakers at that record-setting valuation, Mark Walter is selling the team to Iger and Kushner. Kushner has a minority stake in the Miami Heat and is the younger brother of Jared Kushner, President Donald Trump's son-in-law. The deal is a stunning development for one of the NBA's marquee franchises. OpenAI replaced its chief revenue officer after just 8 months. As Mike Isaac reports, Denise Dresser, who was previously the CEO of Slack, is the latest in a string of executives to leave the artificial intelligence startup. The company said on Thursday that Dresser, hired in December to help build OpenAI's enterprise business, planned to leave for other opportunities. She is being replaced by Dali Rajic, the former president and chief operating officer of Wiz, a cybersecurity firm acquired by Google last year. OpenAI's annualized revenue is on track for $40 billion. And the New York Times reported that a top Forbes editor resigned after the company learned he'd accepted a $6 million gift. As Benjamin Mullen reports, Randall Lane, the magazine's chief content officer, received the money from the founder of Shook Research, which has worked with Forbes on content about wealth advisors. The payment was made after Shook sold a majority stake in Shook Research to PPC Enterprises, a private equity firm, last August. Forbes fired Lane last month after discovering the payment. Finally, our DealBook quiz this week touches on the shifting geometry of global energy. Oil giants in the Gulf are spending billions in a frenzy of activity to find lasting workarounds to the Strait of Hormuz, as shipping through the channel remains perilous because of the war in Iran. Before the war, about 20 million barrels of crude a day sailed through the Strait of Hormuz. As of last week, about how many barrels of crude exports were sailing through the strait? The options: 3.7 million, 12 million, or 18 million. The answer comes from a recent Times article by Lisa Friedman, who reports that 6 months ago, exporting oil from the Persian Gulf was straightforward: produce crude at the cheapest price possible, export it through the fastest route, sell it to the countries that can pay the most. Those days are over. Shipping through the Strait of Hormuz, long the most efficient path for exports, remains greatly curtailed because of the war in Iran. Much of the oil getting through is on tankers navigating a treacherous gauntlet of Iranian attack drones, or running dark with transponders off. Even if a ceasefire materializes, Gulf exporters recognize that relying strictly on the Strait of Hormuz is a risk they can no longer take. That's your briefing for this Saturday, August 15, 2026. We'll be back Monday. If you have thoughts or suggestions, email us at dealbook@newyorktimes.com. Thanks for listening, see you then.